Welcome everyone to QB Power Hour. Today's episode is managing fixed assets in QuickBooks Accountant and QuickBooks Enterprise. Today is Thursday, October the 20th, 2016, and today's course is eligible for ACE, Advanced Continuing Education credits. So if you are an advanced pro advisor, a QuickBooks Advanced pro advisor, you will have a certificate that it's approved for ACE, so you can report your hours to Intuit. We'll speak more about that in a second. Today's agenda is we'll talk about QB Power Hour and the host real quick. Then we'll discuss how the CPE process works and the ACE process, of course. And the topic for today is managing fixed assets, and we'll have three sections. On the first section, we'll do a little bit of theory in terms of accounting methods, and we'll discuss real quick what the difference of the different depreciation methods are, and then we'll discuss the issues with books versus tax, which basically means we will have one depreciation method for our fixed assets in QuickBooks, and we may have a different one on the tax return, and then what are the challenges behind that. On the second section that we'll discuss here, we'll talk about the fixed asset list in QuickBooks Desktop. So how to create the fixed assets, how to manage them, how to make adjustments to them, and so forth. And then lastly, on the last section, we will discuss a tool called the Fixed Asset Manager. It's a special add-on that is included with QuickBooks Desktop Accountant Edition or Enterprise Edition. Okay. So about QB Power Hour, we are a webinar series, usually twice a month, Thursdays, 12 p.m. Eastern. Next episode will be in 2 weeks. We will talk about advanced QuickBooks payroll topics with the guest speaker, Greg Bosson, one of my favorite QuickBooks trainers out there. Next episode is not ACE approved, ACE approved. This one is, but next one is not. Typically, we talk about QuickBooks Desktop and QuickBooks Online. Sometimes we mix 50-50 in a webinar. Sometimes we'll do one desktop, one online, and this is the case. Right now, we're 100% QuickBooks Desktop. So if you don't work with QuickBooks Accountant and you don't work with QuickBooks Enterprise, this stuff will not be that useful. But even if you're just an advanced certified pro advisor on the online, you still get the ACE credit. Michelle Long is not here today. I think she's out doing some training. She's out traveling, but she's the author of multiple QuickBooks books, and she's the co-host of QB Power Hour, and she comes in so sometimes together with me or alternatively with some of the episodes that I can. And she runs the LinkedIn group, which has over 160,000 members. I strongly recommend you look into that. Myself, my name is Hector Garcia. I'm a CPA. I live and work in Miami, Florida. I teach QuickBooks on here and also have my own clients. If you need to reach me, there's my email and there's my Twitter handle. My email is hector@garciacpa.com. Some of the upcoming events, outside of QB Power Hour, we have QuickBooks Connect coming up next week. Obviously, if you are not signed up for it yet, I doubt that you're gonna somehow sign up within a couple of days. But that's a great, huge event. Almost all my friends and colleagues in the QuickBooks world will be there. Sadly, I will miss it, but I have a good excuse. I'm taking care of a newborn here at home. Also, if you want to get advanced certified or just regular certified or attend Intuit's Firm of the Future events, go to QuickBooksTrainingEvents.com. There's events all over the country, multiple cities from today until January 12th. Most major cities are there, and for some people, it will be very small travel time. Most of these classes are free. I believe all these classes are free, and they're run by Intuit, and they're excellent. So QuickBooksTrainingEvents.com for that. Now, this webinar, it's eligible for CPE. You only get the CPE if you attend live, so you must be watching it live, as most of you are now. If you're watching it in YouTube recording, you don't get the CPE. You must be logged in for at least 50 minutes, so throughout the entire hour. We're going to give you a CPE password in the middle of the webinar. Write that down. And then near the end of the webinar, we'll have a polling question. And as long as you answer that correctly, you're eligible for CPE. And we normally tell you to wait about 3 weeks for CPE certificates to be emailed. I am behind CPE certificates for the last two events. So we have not yet sent 922 and 1006. I'm going to go ahead and send all three, including today, in the next couple of days when I get a chance. Now, we are going to report to Intuit the attendees that are here today for A's. But the exact process on how you do that, how you self-report through Intuit, has not been published yet, because Intuit, I think, is coming up with those instructions in the next couple of weeks. So for now, just save your CPE certificate, because your CPE certificate will be your proof. Okay, so let's dig right into the topics. So we're going to talk about depreciation methods, discuss the concepts of books versus tax. Then we'll talk about fixed asset item list in QuickBooks Desktop in all PC editions. And then lastly, we'll talk about the fixed asset manager, which is an add-on. It's a separate piece of software, but it's included with QuickBooks Desktop, Accountant, and QuickBooks Online. So let me just do a quick polling question here. I just kind of want to get an idea for how you currently handle depreciation. So the question is, do you book depreciation in QuickBooks, and how or when? I guess it's so kind of take a look at all the options there so we can get the best possible answer. Okay, we have about 60% of the votes in. And I will show you the results. So they're kind of interesting. So we have about 86% of the votes. Let's get to 90. Let's get everybody voting in. Let's get a good, clear answer on this. Okay, yeah, we got about 90% of the votes now. So let me close the poll and show you the results. So interesting, it looks about 37% of you book it throughout the year. That means that you do monthly or quarterly journal entries. 21% of you book it once per year. And 31% of you don't book it proactively, just wait for that tax return and take out the fixed schedule from the tax return and book it from there. So we have an interesting mixed crowd here. 10% don't book depreciation at all. Thank you very much for answering that. So let's talk about some basic topics. And a huge percent of you said you book it already, so this stuff is basic. But I want to go through it because these are some important accounting concepts that are going to come up in explanations later on when we talk about the software itself. We're going to use some terminology that you must have on top of mind. So some of these are basic accounting concepts, but I'm going to go through them no matter what. Fixed assets, they're purchased for long-term use, and they're likely not convertible into cash, right? So for example, accounts receivable, a security deposit, inventory, all those things are easy to convert into cash. However, fixed assets are not. You have to, it's a much more complex sale to get rid of them. So as long as they kind of fall into that category, or they're used for production, they are considered to be a fixed asset. Now, a fixed asset will have a life. The lifespan should typically last more than a reporting period or more than an operating cycle. So for example, if I buy something that is going to last me exactly 1 year, it's really not worth it to call it a fixed asset and depreciate it, because it's just not going to span multiple accounting periods. Then it just makes sense to just expense it. So I think general rule for me, anyway, the way I treat them is they need to last at least 1 year. Now, there's going to be a value threshold. In other words, for example, I buy staplers and I buy calculators that last me years and years and years. So it does fit into the 1 year rule that we were talking about earlier, and it is not easily convertible to cash, because technically people are not out there buying calculators and, and staplers. However, because of their value, it would be so much minutia to put in your balance sheet that there has to be a general accounting policy where you say, look, our company decided that X dollar amount will be the minimum value. So if it's less than that, doesn't matter if it falls into the quote unquote fixed asset definition, we're going to go ahead and expense it, just because it's just not worth it because of its value. Now, General rule for that for years, I think ever since I have worked with tax in 1998, for years the general rule has been $500. Now there's no book that says this is the dollar amount. This is just kind of the general rule that was used throughout, mostly because the IRS published something called the Safe Harbor Guidance, where they basically said, hey, general rule if it's more than $500. Again, general rules are, like I said, general, right? There are some special cases in which they don't count. However, in the past couple of years, we've seen fixed assets that that people buy quite often be worth a lot more than $500. You have a phone, a laptop; those things are worth way more than $500. So Intuit actually, I mean, IRS last year upped that safe harbor guidance to 2,500. Now, whatever policy you use internally, whatever dollar amount you use, it's up to you. There's no rule per company or company type, but you can start thinking about that $500 and that $2,500. Now, this will vary because a company like Apple or Google, they can buy a $10,000 computer, and for them that's peanuts. They're not going to put that in the balance sheet. They're only going to put, let's say, things are worth $50,000 and more, and the rest they'll expense. But for a little guy like me, $10,000 investment is a really big one. It's significant in my balance sheet. So this whole threshold, it's all based on the company and the size, and there's a little bit of subjective reasoning for this, and that's really what the accountant's job is. Now, what is depreciation? Depreciation is the reduction of value of an asset with the passage of time. Typically, the wear and tear of the asset, um, or representing the wear and tear of the asset, it's the purpose of depreciation. Now, there's also this concept of life expectancy. If you have something that lasts 5 years, the wear and tear should be spread across 5 years. So that's what depreciation does. It creates a mechanism to correctly book or account for that reduction in value over time. Now, this is represented as an expense called depreciation expense that goes in the income statement or in the profit and loss. Depreciation follows the matching principle from the principles of accounting, which attempts to make sure that expenses match the related revenues. Now, accumulated depreciation is the same depreciation that you book, but it adds up over time. So 2, 3, 4 years worth of accumulated depreciation, it's all added together and it's booked in the balance sheet as a reduction of the asset value or a contra asset. Now, the book value is basically the original purchase price of the asset minus the accumulated depreciation. So that's a really important concept because book value is something that we're going to be talking about throughout here. Now, what are the components of depreciation, or what things do we need to know or have right off the bat? Okay, right off the bat, in order for us to do any sort of depreciation. Number one, we need to know what the depreciable basis is. Now, in some cases, there's assets that have mixed use, half personal, half business. And if that's the case, you have to back out the personal portion of the asset because you can't depreciate that. So that's one of the ways you can take depreciable basis. Also, there's other non-depreciable bases, which are things like land, for example. Land cannot be depreciated, not for tax, not for accounting purposes. Land, in theory, doesn't lose value or doesn't wear and tear. So land is extracted from the depreciable basis. So as long as you can identify what portion is depreciable, what part is not depreciable, that's kind of the starting point. Now, the useful life is extremely important, and there is general guidance on both the tax side. On There's multiple publications explaining based on the type of the asset class, what their useful life is, and there's also guidance on the CPA world on the GAAP side. But for the most part, I think it's going to have to be your judgment too in terms of how long an asset lasts. Now, assets that are well known, like vehicles or computers or furniture, those have specific rules and they must fall into 5 years, 3 years, 7 years. Okay, so you have to follow those specific rules. Is not 100% subjective. However, some assets that don't fall into a particular category, things that are new in nature in terms of what they are, brand new product, something that doesn't fall into any category, then you're going to have to figure out that recovery period or that useful life. Now, the date that is placed into service is extremely important. Okay, so this is not equal to the day you buy it. This is the day that is starting to be used in the operation. So, classic example is, let's say I buy a piece of real estate in March, and I from March to October, I basically just add more improvements to it, and then in November I start renting it. So that asset was placed in service in November, to make sure that's accurate. Also, it could work the other way. You could buy the asset, let's say on December 15th, and not pay for it until 2018, right? Because you had um, a special deal with the dealer that was giving you no interest for a couple of months or whatever. So it's when the asset is placed in service that is officially recognized. So it doesn't have to be paid, or it doesn't have to match. Sorry, it doesn't have to be paid right away, or it doesn't have to match the payment. So it's a really, really important one. And last one is salvage value. Now, for tax purposes, we typically ignore salvage value, but for accounting or for book purposes, we do have to know salvage value because most traditional accounting methods, depreciation methods, will take that in consideration. So the salvage value is what the market value or resale value of the asset would be at the end of its useful life. So, for example, if you're going to depreciate a truck for 5 years, it doesn't mean that it's worth literally nothing at the end of 5 years. It means it's going to be worth something. So we have to book that in order to consider what the depreciable basis is. So the mechanics of depreciation are pretty simple. You take the acquisition purchase price minus the non-depreciable portion minus the salvage value, that gives you depreciation basis. And then if you go with the simplest level of depreciation, which is straight line depreciation, you take that depreciable basis and you divide it by the recovery period. So if you're going to book depreciation annually and you have a 5-year asset, you take depreciable basis and you divide it by the years, and then that would be your annual depreciation. If you book depreciation monthly, then you're going to divide it by the number of months. So that will give you the depreciation amount that you need to book. Now, we're gonna start getting a little bit deeper into this, right? Because it's really important to kind of slowly get deeper into it, but we're gonna get deeper into the methods before we go into QuickBooks. Now, straight line is this, as I mentioned earlier, this is the most simplest way to depreciate. You're actually allowed to depreciate in straight line as your normal or baseline form of depreciation for both tax and book. But you can also look into other acceptable methods. For example, the output method, which in 15 years I've been practicing, I've never used, but this is useful for certain types of companies. If you have an asset that doesn't have a lifespan that is measured in time, but is measured in usage. So one of the examples is a boat engine or an airplane engine, right? With boats, we don't really measure mileage the way we do with cars, or with airplanes, we don't measure mileage like we do with cars. So we do the number of hours used. And most manufacturers will say, well, this engine will last you before you have to overhaul it 1,000 hours, 10,000 hours, whatever. So if you have a way to measure the units of production, you can use that output method. Okay. But again, I don't use it a lot. I don't deal with a lot of companies that have those type of assets, but that's an acceptable gap method. Now we have the double declining balance, which is an accelerated method that is most often used in tax. The double declining balance basically takes the depreciation of the year and calculates the book value, and then on the next year it uh, you multiply that percentage times the book value ongoingly. So what ends, and we'll do an example of that, we have a slide on that. So what ends up happening is you take a lot more of the depreciation up front. Now, why does double declining balance exist? Well, there's an old saying that says, when you go buy a used car, the minute you drive it off the lot, you lose whatever 20% of its value, 25% of its value. I forget what the number is in that saying, but that is displaying or illustrating that there's a more immediate, higher level of reduction in asset value at the beginning, and a much smaller or slower towards the end of its life cycle. So when you're a taxpayer, and you want to and you part ways with money to buy an asset, you want to take as much as that as a deduction. And what the accelerated method does is it allows you to do so. Um, there's also the sum of digits, which I don't want to get to because I never use, but it's there, and you have the slides if you want to research it or Google, but that's another accelerated method. Now, let's do some comparison of straight line versus accelerated. So I think most people understand straight line extremely well, right? You take a $50,000 asset that would last you 5 years and has a salvage value of 10,000, which basically means that the depreciable basis is 40,000, right? Because it's going to be worth 10,000 when I sell it in 5 years. So I take that 40,000 and I multiply it times 20%. Now, why 20%? Because that's a fifth, right? 5 years, a fifth, and I book $8,000 of depreciation, and I start calculating my book value based on the asset value minus that depreciation, and then when I'm done depreciating at the last fifth year, I'm going to be left just with the salvage value. So you notice that every single year I take an $8,000 expense or $8,000 deduction. Now, why does the double declining balance work so well, and why was it even invented for it? Is because we can take the asset value, multiply it times, that's why it says double the amount you would have in a straight line method, and on the next year, you take the same percentage, but you multiply it times the book value. So you start seeing how you get, for example, on the last 3 years, on the double declining method, you get a much smaller deduction or expense than in the straight line. But if you look in the first 2 years, look at 8,000 versus 20,000 on the first year alone, you get a much faster depreciation. Again, this is with the purpose of illustrating or showing that the asset itself loses a lot more of its value within the first couple of years. Now, for tax purposes, I don't want to get too much into the weeds of the tax methods, but for tax purposes, you can read publication, I think it's 552 or 952. I'll give you the number in a second. And it's a huge document that tells you exactly what percentage to use when using the accelerated method. And there's also something called a convention, which I'll talk in a second. So you find the number of years that the asset is worth, for example, the 7 year asset, and then it'll tell you exactly how much to use. Right now, the fixed asset manager will do that for you, so you don't have to worry about going through the tables and stuff. But these tables were existed basically for when people don't have a computer or tax software. Now, good, somebody's asking a question, why is there no salvage value on double declining balance? That's actually part of the method, right? A straight line uses salvage value, double declining does not. Okay, so you ignore salvage value with double declining. All right, so let's get in deeper into tax methods. So in the IRS has basically three types of accelerated depreciation. It has the makers, which is the table I showed you earlier. It has something called Section 179, which actually allows you to fully depreciate 100% of the asset, and there's certain rules in terms of dollar limitations and stuff like that, the year that you put it in service. So what's really nice about this is you get 100% of the depreciation just as if you had expensed the asset, but you get to book it in the balance sheet with its depreciation, which I think is a much better presentation than putting it as an expense. Now, there's a limit. By the way, somebody here is telling me it's publication 946. Thank you. Sorry. So publication 946 is the IRS one. And also somebody's asking, how do you come up with salvage value? So Amanda, you would use scientific methods. Like for example, if it's a car, you can take the estimated blue book value, stuff like that. So you have to both subjectively and objectively look for methods to explain or prove how you figured out that salvage value. Anyway, going back to section 179, there is a limit on how much section 179 you can take on the year. So for example, if I have a $30,000 taxable income that year, and I want to fully expense through section 179 a $50,000 asset, I can only fully expense up to 30,000 because that's limited to my taxable income, and the difference of the 20 gets fully suspended for the next year. So section 179, it's there literally to make you pay zero tax, but it's not there to create a loss. Okay, that's an extremely important point. Somebody here is saying the Donald Trump write-off. Yep, he took a couple of really big depreciations that year. Anyway, bonus depreciation is a little bit different. So different tax years have different rules, but in certain tax years, there was this thing called 100% bonus depreciation, which doesn't exist anymore. It was then during the recovery of the economy. They were trying to encourage people to buy assets, even if it took them to a loss. So the nice thing about the bonus depreciation, which in today's world, I think there's a 30% and a 50%. I have to go back and check next year's rules. But what's nice about bonus depreciation is you can take a much deeper depreciation the year that you buy it, but you can go into a loss with the bonus depreciation. So think about a taxpayer that has multiple sources of income. So for example, they have a salary and they own the business, and the business has a loss. Now they're going to get a refund, or they're going to have a much smaller taxable basis. So bonus depreciation is something that most people really like if it can take you into a loss, and that loss can pass through and lower other taxable income that you have. So section 179, again, is obviously limited to the value of the asset, but also limited to the taxable income. Now, somebody else is asking that am I covering accounting rules or U.S. tax rules? Keith, these are U.S. tax rules. That's why we have IRS up there. I don't know what the Canadian rules are or the UK rules are from whatever you may be connected from. So these are U.S. IRS rules. Now, the last important thing about tax considerations is something called the convention. So in regular accounting rules, if you have an asset that was put into service, let's say, February 10th, then most people will just make the date of service March 1st or February 1st. So it's a little bit of a loose interpretation. We could just take a full month or just start the next month because it's an estimate anyway. It's not a huge deal. But in tax, it doesn't work that way. In tax, you have to pick one of the three conventions. You either pick half year, mid-month, or quarter month. And most people don't really pick quarter month. It just happens. I'll discuss them in a second. So most assets, I would say most assets fall into half year. That means if you buy it January 1st or December 31st, you get the same depreciation, which is half year. You get half of the first year. Mid-month, it's mostly for real estate. So if you buy real estate, you get to take half of the month that you placed it into service, and obviously every consequent month for the year. And the quarter month, the quarter, sorry, not quarter month. I don't know why I put that. It's mid quarter. So the mid quarter is a method that if you buy most of your assets, or you place most of your assets in service in the last quarter of the year, you can only take basically a month and a half worth of depreciation. It defaults to the middle of the quarter. So this has to do with people trying to buy assets December 31st just to lower their taxes. And what this method, the mid-quarter, does is it reduces the impact of the deduction on that. Okay. All right. So that's okay. So why did we spend all this time? Okay, so why did we spend all this time talking about those basics is to get to this point: books versus tax. On tax returns, on US tax returns, we will apply tax methods. In QuickBooks, most people will either wait for the tax return to be done and book it. So basically, their QuickBooks matches their tax return. That's what I call the easy life. I do that a lot of times, by the way. I don't have a lot of companies that actually require GAAP-based depreciation methods. However, if your company has to report in GAAP, generally accepted accounting principles, right? If your company has to report in GAAP, you have to use GAAP methods only. So you have to use, straight line method or whatever method your company adapts, and you're going to have to keep basically two sets of depreciations in the books. You have to keep the book and the tax separate, and the difference between it, you have to book it in the tax return. So without getting too much into the weeds about the mechanics of it, in the tax return, there's something called the Schedule L. Whether you're a corporation, a partnership, S corporation, the Schedule L is basically the place where you put the balance sheet, but the balance sheet on the Schedule L is the book's balance sheet, not the quote unquote tax balance sheet. So if there's a difference in the reported depreciation and book value of the asset, you have to report that accumulation in the Schedule M1. And most people have to keep a spreadsheet or some other method of doing that. So this is the challenge. And this is where when we talk about the fixed asset manager, which we'll demonstrate in about 10 minutes, we'll talk about the value of the tool and how both of those things get booked together. All right, so let's talk about managing fixed assets in QuickBooks. I'm going to specifically show you how to use the fixed asset list and the fixed asset manager in QuickBooks Accountant Edition or QuickBooks Enterprise Edition. So if you're working with QuickBooks Online or QuickBooks Mac, QuickBooks Pro or QuickBooks Premier, none of those four are going to be eligible for this function. This is only available in, as I mentioned, in Accountant or Enterprise. So first, let's talk about sort of the traditional way that we manage fixed assets, quote unquote. So right now, I'm going to go into company financial balance sheet, and I'm going to see what we have on our balance sheet in terms of assets. So as you can see, right now we have an account called computer and office equipment, which is $2,500. If I double click on that, I actually get to see the exact transaction that cost that $2,500 to happen, which basically was a check, which it could also be a bill. But the key thing is, traditionally, when you book the asset, you book it at the purchase. So if it's a check or a bill, you book it, and then they pick an asset, a fixed asset, whether there's already a general category like computer and office, automobile, or office equipment, something like that, or you create an asset account for each account. So for example, if this was an equipment that we wanted to label it specifically, we can just add new and click on fixed assets, hit continue, and then we can call this one the Dell server, for example, and then hit save and close, and that would certainly book that particular transaction into the balance sheet. You will see it there clearly. And again, this is not what I want to show you yet. That's an alternative. We'll discuss the alternative in a second. Right now, I just want to show you how we traditionally do it. And then when the depreciation is actually booked, somebody actually literally goes into QuickBooks and creates a journal entry per month, per quarter, per year, and books depreciation expense and accumulated depreciation. Now, the problem is that coming up with this number would require you to have a special spreadsheet, because QuickBooks, the core software, doesn't have a depreciation calculator. You're going to have to use a different tool, which is the reason why I mentioned Enterprise or Accountant, because it comes with Enterprise and Accountant to actually calculate and manage those. So we'll discuss those in a minute. So what I want to offer as an alternative to just booking the depreciation through manual journal entries is to use something called the Fixed Asset Manager. Now, the Fixed Asset Manager can be accessed by clicking on Company and then Manage Fixed Assets. If you're working with the Accountant edition, you can click on Accountant, Manage Fixed Assets. It would actually be the exact same thing. So I'm going to go ahead and click on that, and that's going to launch the Fixed Asset Manager. Now, the first time you launch it, it'll ask you a whole bunch of questions, which you just read and answer through. I already had done that. I already used it in my computer, so it just opens straight into the software. Now, as of right now, this Asset Manager is connected to my QuickBooks file. You can see up here with the company name. Let me go ahead and maximize this. So this one is called Engineering and Architecture Firm. If I open my QuickBooks file, you see up here that it's called Engineering and Architecture Firm. So that's how you know which file you're working with. Now, if you already went through the questionnaire, the questions that you had, it can be changed here under File, Client Information. If you actually click on that, you get to choose which is a depreciation period. You get to use how many different calculation methods you would like to use. So for example, you get a total, in this particular case, you get a total of 6 options. You get the default, which is the federal. This is the tax option. And then you get the 2 side calculations, which is ACE and AMT. These are also tax related. And then the ones that most people really worry about is having an accounting method depreciation, and also possibly having an alternative to state taxation and maybe local taxation. So you get to pick how many different depreciation tables you would like to work simultaneously. And the Fixed Asset Manager will calculate the depreciation, the book value, the accumulated depreciation, the salvage value individually in each of these 6 methods. So I can actually pick and choose to see how many I want to manage. So I just put a checkbox on the ones that I want to manage, and that's it. Now here where it says methods, this is basically where we pick the default methods that the assets are going to have once we start creating them. Here where it says groupings, we can actually group these together in the items in a very specific way. We can give them item IDs. This is really more important when we're integrating with our tax software. So for now, let's just skip this whole groupings tab. And then here on account, this is where you see the chart of accounts that basically reflects the same chart of accounts as your QuickBooks file. So if I click on list chart of accounts, the same chart of accounts that I'm looking at here should match the chart of accounts in here. So it's just basically a quick way for you to kind of just see the general settings off of it. So we'll get a lot deeper into how this works in a second. But let me go ahead and click OK. Now you're going to see that we have a couple of tabs here. We have Schedule, we have Asset, we have Disposal, we have Projection, we have Notes, and we have Calendar. So Schedule is gonna be the list of all the assets, which right now there is none, and I'll explain to you in a second. Asset is gonna be asset by asset, where we actually configure the depreciation methods that we're gonna use, the convention, the useful life, the salvage value. All those things are gonna be entered in here, but we're gonna start the process from QuickBooks. So I'm gonna show you exactly how that works. In Disposal, this is where we're gonna track the assets that we sold. So this software will actually let you know what the actual profit or gain on the asset is, including the calculation of depreciation, which is really, really important, especially for tax. And then Projection will basically project depreciation for the future. Anyway, so the reason why there's no assets here, there's a blank one here. Let me go ahead and delete it. There's no assets here is because we haven't set up any assets in QuickBooks. So let me go back into QuickBooks here. And yes, we do have a fixed asset account called Dell Server. However, this doesn't transfer or translate over to Fixed Asset Manager because it needs to be part of the fixed asset list. So the fixed asset list is up here. We're going to click on List, and we're going to click on Fixed Asset Item List. So that's a really important piece. You have to work with the list as well as the chart of accounts. You have to work with both for the Fixed Asset Manager to work. So List, Fixed Asset Manager, and for now the list is blank. So the list is blank because we haven't actually created our fixed asset items. Now that's a really important concept. We're going to have fixed asset items, and we're also going to have fixed asset accounts. And the accounts, which are going to be the ones that are in the chart of accounts, are going to play a pivotal role in the presentation of our financial statements, of course. However, the list is going to be used for it to create the individual depreciation tables for each specific item. So in here, in the fixed asset item list, again, we go to the list menu and click on fixed asset. We're going to right click anywhere in the blank screen and then click new. And then we're going to proceed to create our fixed assets. So for example, we'll do the Dell server that was there in the books earlier. And then we're going to put here a date. Let's say we put this in service July 1st, 2016. We'll go ahead and put the cost. You have to put a description. So I'm going to go ahead and copy the item name to the description. However, I could, if I wanted to, have a complete separate description. And then there's a couple of separate boxes here like location, notes, PO number, serial number. These are things that I can add, or I don't have to add if I don't want to, but you have space to add information there. Now I can't hit OK yet because I have to select an asset account. So it's completely necessary that I tell it which chart of accounts account this item is linked to. So in this particular case, I'm going to link it to the Dell server account that we had created earlier because this actually makes sense, right? So I have the item and then I have the account, and both of these things match. So I'm going to go ahead and hit OK. And there's my first asset. Now let me go ahead and create a new one. Let me go to new, and then I'm going to create a vehicle. So I'm going to call it here Toyota truck, and I'll go ahead and copy and paste that description in the bottom. I'm going to go ahead and put when I bought it. So let's say this was February 15th, 16, and the cost of this one was $23,600. Again, I'm going to have to select that asset account that it goes to, but I'm not going to select that individual asset. I'm going to go ahead and click on automobile and trucks, and I'll click OK. Perfect. So now I got two assets that I purchased, and there's no limits on how many I can have there. If I click down here where it says reports and I click on fixed asset listing, I go to a special report where I have all my fixed assets, and I can actually pick and choose what columns and what fields I can see in there, and we're going to get to that a little bit later on. So let me go ahead and hit escape there to close that, and let's go into our fixed asset manager. So let me go to account, manage fixed assets. That's going to go ahead and launch my fixed asset manager. Now this is not programmed to automatically sync with QuickBooks desktop and bring the information. I'm going to go ahead and click on QuickBooks menu up here at the top. I'm going to click on QuickBooks, and then I'm going to click on update assets from QuickBooks. So once I click that, it's going to ask me, do you only want to bring new ones? Do you want to bring the modified ones? Do you want to bring both of the modified ones? So I'll just pick the first one, and then I hit OK. And then what this software will do, and again, this fixed asset manager is free. It's included with QuickBooks Accountant and QuickBooks Enterprise. So it works hand in hand. But it will do is it will connect it to QuickBooks, and it will bring those assets over. So you can see both assets in there. If I click on asset, I can actually put any specific details that I want. So for example, for the Dell server, notice that the serial number that I put is there. I can choose, to put additional information in here. But one really important piece, I'm going to go ahead and scroll down a little bit, or I'm just going to bring the screen down. It's the general asset ledger account. This is not going to work if I don't map it. Okay, so you notice that I already mapped it to my fixed asset account, but I also need to map my accumulated depreciation and my depreciation expense. So most companies will have a single accumulated depreciations account, and they will have a single depreciation expense account. Now, if you want to have multiple depreciation expense accounts and subcategorize them by asset class or whatever, you can do that. If you want to have an accumulated depreciation account per asset, you can do that as well. Or you can actually even pick the same Dell server fixed asset as my accumulated depreciation account, because it's just gonna lower its book value. So it really works any way you want to. I mean, there's some really important sort of accounting concepts that you need to know and understand before doing that booking. But if you follow the specific instructions I put here, you really don't have to know that much more. So just pick the fixed asset, pick, actually this is supposed to be accumulated depreciation and depreciation expense. And there's a couple other things when it comes to grouping, so we can group them together. This is more for reporting purposes. If I have really big asset lists, maybe I want to group them in any specific way. Now let's go down here to the bottom. This is really the meat and potatoes of the software here, which is, we have 3 different methods for depreciation, and each method could have a whole different set of information. So for example, for whatever reason, let's say that for federal purposes, we need to pick a different date than book purposes or state purposes, then I'm welcome to change that. Now, the cost basis really doesn't change most of the times across different methods, but if you must have one, then you can change it there as well. Now, this is a really important piece, depreciation method. Depreciation method, and don't want to get too much deep into the different depreciation methods. I have another video and the earlier session, which we talked about the different depreciation methods. But this is where you can actually pick what method they are going to have. So for example, something very, very common in the tax world is you're going to have this thing called 200% double declining balance. That's just a type of depreciation. And then on the book world, in the non-tax world, on just regular financial statements, it is very common to have straight line. So I just want to kind of just compare these two, the double declining and the straight line, and you're going to see each of these are going to have their own method. Okay. Now, the recovery period. Now, let's say, for example, that for federal tax purposes, a server lasts 5 years, but for book purposes, it lasts 3 years. Then I just change this to 3, and then this is months, by the way. So if you wanted to do like 2 years and 6 months, 2.5 years, you would put 2, 6. And then we'll ignore a state for a second. Let's just kind of focus on book versus tax, because that's kind of really the hot topic, is comparing books versus tax. So let's say, for example, that the convention that this asset for tax that it had was mid-quarter, because it just happened to be that way, and don't want to get into the details of that. And let's say that for book purposes, it's going to be actual days or full month, which is going to give you the same result because they're both on July 1st. But let's also say that for tax purposes, we are going to have a special deduction. For example, we're going to have on the federal, we're going to have a special bonus of, let's say, 50% of the asset. Okay, so that's a special tax rule that allows you to take 50% of the asset. So you see right here, it's going to immediately depreciate $1,250, which is half of the asset. And then down here in the bottom, I get to pick the business use percentage. So let's say, for example, that for tax purposes, we're going to say that this is 100% business. However, when you deal with vehicles and stuff, sometimes if they're mixed use, you actually have to put a percentage there. But the most typical thing, it's going to be 100%. Now, salvage value, which is up here, is normally ignored on the tax world, but you have to put some sort of salvage value for the book world or for the standard accounting world. So we're going to go ahead and put a salvage value, which is how much we think this computer is going to be worth at the end of 3 years. Let's say that we think it's going to be worth about $600. So what this will do is it will now only depreciate $1,900 from the book and do that in straight line for 3 years. And then for federal, it will do the full 2,500. It's going to take 50% up front, and then it's going to do the rest in 200% double declining. Now, I don't want to get too much into the weeds in terms of what methods you have to use and how do you know. I mean, you may need some formal accounting training for that, or you can go into the IRS website and pull up publication, I believe is 945, which explains everything about fixed assets and depreciation. Anyway, we get to see right here what the current depreciation is going to be, which is 187 in this case plus the special allowance, and in this case it will be 316 for book. Now, why is this significant? Let me go ahead and save this, and let's pull a report. This is significant because of reporting, because the only reason why we would do this and spend all this time managing the fixed assets is because we want to have nice reports explaining to us exactly what's going on. So let me go ahead and go to display reports, and then I'm going to go down to depreciation schedule by user defined 1. And by the way, you basically get 5 predefined depreciation schedules. So I'll just pick one. It really doesn't matter. Anything that says depreciation schedule on it, even depreciation schedule by GL, that stuff works too. Any of these work. So let me go ahead and do the federal first. So you notice down here, you get to pick which report you want to see. So I want to do federal or book, and we'll compare those two in a second. And then let me go ahead and hit OK, and let's take a look at this report. So this report tells me that my Toyota truck, which is actually automatically is posting some depreciation, even though I didn't change any of the settings. These are based on the default settings. It's showing you there. However, the Dell server, which is the one that we spent quite some time putting together, is telling me exactly what's going to be depreciated the first year, which is 1,437.50. Let me go ahead and get out of there. Let's go back to schedule, and let's work now with the truck. So let me go ahead and double click on the truck, and let's say if like I mentioned earlier, if you wanted to add some additional comments, you can do that there, additional description, that sort of thing. But we have to do the mapping, really important. So we're going to do accumulated depreciation account. We can pick the accumulated depreciation general account. And for the depreciation account, again, this is going to be the most typical. We're just going to have one depreciation expense account. There we go. Okay, and then down here, let's say for book purposes, a vehicle will last 7 years. And I'm not telling you that's the general rule or anything. I'm just saying, let's just say that's how it works. We're going to make this truck worth 7 years. But for tax purposes, we're going to do 5 years. And then we can also say for book purposes, we're going to use, let's just do it again. We'll do a straight line. And then for federal basis, we'll go ahead and pick the same one here, 200% double declining. However, we won't take an initial bonus on it. So we'll just do straight depreciation on that. And we're gonna put here that this is 75% business use. So what this will do is you watch right here where it says depreciation. This is gonna go down by 25% because there's a portion of it that is personal use. So it's really neat here. For tax purposes, we're gonna go ahead and say that it's a percentage of personal use. But let's say for book purposes, we're gonna keep it at 100%. So what is really nice, it creates multiple depreciation schedules. And let me go ahead and now pull the report, go to display report, and then I'll pick a different one. I'll pick this one called depreciation schedule by GL account, and you're gonna see what that looks like. So there you go. You're gonna get to see what the current depreciation now, which is based on the new settings, is gonna be an entirely different number. Okay. Now we get to pick when we do the report. So let me do report again and display report. We get to pick if I wanted to see my federal schedule or my book schedule, right? So that's a really important piece. So let me go ahead and pick now book and hit OK. Actually, I picked the wrong report. Sorry about that. Reports, display report, book, and then we'll go down to depreciation schedule by GL account number. And now you see entirely different numbers are being booked here. So this is interesting, and as you start kind of playing with it and adding more assets and changing the conventions and the recovery period or the useful life, you get to see how all these depreciations get calculated differently. Now, right here where it says projection, this is awesome. Where it says projection, this software would actually tell you what the future depreciation schedules are going to be for this asset, and you kind of get to see exactly how this will play into the future. Now, if I do a report for that, so let me go to report, display reports, and then I'm going to look for the report where I can see my complete depreciation schedule. So let's go ahead and pick this one, and then I'll go to federal and then hit OK. You get to see, like I said, current year. Now, let's say, for example, that now I'm done with this year and then I want to see the next year. So I can go to File, Client Information, and then I can just simply change the year here. So let me go ahead and put 2017 and then hit OK. And what's going to happen is it's going to recalculate, and then we go into Reports, Display Report, and then I'm going to scroll down and take a look at depreciation schedule by user defined one, or I can also pick by GL account. Either one works. And I pick depreciation through, so I can do it through the end of the year, and then I can hit OK. And then I get an entirely different depreciation amount, because that's going to be the depreciation for the next year, right? Because I changed the depreciation cycle. Now, you don't have to do this per year. You can actually do them even in monthly increments. So for example, let me go back here to client information, and let's say we were going to do from July 1st, so July 1st, 2016 through July 31st of 2016. So we're looking at just a month's worth, okay? And then once I have this loaded up, I can go to reports, and this is obviously the same thing over and over, display reports, and then I can pick my report, and then I can do depreciation through 07/31/2016, and then hit OK. And you see actually a whole different depreciation schedule, because that's going to be the first month basically, and you get the bonus right away, and then you get a smaller amount. So this kind of just starts giving you an idea of how that works. And even when you do that report, you can actually, instead of just putting the date, I can just say, look, give me the depreciation of month 8 or month 7 or whatever, and that will work as well. So this utility is just really, really powerful, and you have a lot of different choices. You can also pick and choose which assets you want to see. So if I only wanted to see the asset that I selected, I'm going to go ahead and get a report just for that particular asset. Okay, so that's building the assets, changing some of the settings, building the reports, and kind of just getting acquainted with that. There's a couple of other interesting features here. So here where it says Asset Tools, we get a couple of really interesting tools that you can do. For example, I can actually take one asset and go to dispose, and then I can say, look, I'm going to go ahead and sell this, and then once you put the sales price, whatever the sales price happens to be, let's say I'm going to put here 14,000. QuickBooks, Fixed Asset Manager is going to calculate exactly what my gain and loss on the property is, even after calculating depreciation. So that's really neat about disposal. Okay, here where it says Asset Tools, you can also do some interesting things like split off an asset. So for example, let's say an asset kind of gets converted into something else. You can actually grab one asset and kind of split it into two. So it's kind of really interesting. Or 2 or 3, you can convert one asset into multiple assets, keep the history up to the split portion, and then in the future you have two entirely different assets that can have their own depreciation schedules even. Now let me go into File, Client Information, and let me do the entire year again, because that's kind of the common thing that we do, is we do this per year. And then I'm going to show you something else. I'm going to go here into reports, and I'm going to show you display tax worksheet. So what this does is this actually creates the tax form for you, or the worksheet that you need for the tax form. Okay, it's really, really cool. So when you hit OK here, you get the tax form. It tells you exactly which line on the tax return it goes into. And if you already are a tax preparer, or you have an accountant for this, then you don't have to worry too much. But it's actually really nice to know that those tools are all available within the fixed asset manager. Now, the most valuable piece of the fixed asset manager, it's saving the time of not having to come in here and create the journal entries. This is the real big deal here, of not having to do the journal entries by hand. So going back to the fixed asset manager, this is where it becomes really useful. So I'm going to go ahead and click on QuickBooks, and then I'm going to click on where it says post journal entry into QuickBooks. Now, before that, I always recommend clicking on Save Assets to QuickBooks, just in case you had some additional notes and attributes to the asset itself, and you want to bring that information over to QuickBooks as well. That way, when I go into my fixed asset item list here, I can go into any of these and I can see new information. Like, for example, you see here where it says fixed asset manager, asset number 1, accumulated depreciation. It actually brings that information over and stores it in the fixed asset list inside QuickBooks. So that's the valuable piece of bringing the information back into QuickBooks. Anyway, to create that journal entry, we're going to click on QuickBooks, post journal entry to QuickBooks. So I'm going to go ahead and click on that. And then it tells me, well, when would you like to post a journal entry? So I'm going to put here 12/31/2016. Hit tab, and then the system will kind of calculate my debits and my credit entry. If I actually click on show assets, we can see them broken down by asset there. So you can see them broken down. Now, they don't come in, they don't get posted individually like that. They'll just be one overall journal entry, just for the 38, in this case for the 380750 debit and the credit as well. Now I can choose whether I want to post the tax depreciation, or I want to post the book depreciation. Now you can't change it back and forth, and you really shouldn't be changing it back and forth, by the way. So if you start with just posting book, you're going to post book forever. If you're going to be posting federal, you're going to be posting federal forever. But it's really important, and it even gives you a warning right when I made that change, that you shouldn't really be changing methods back and forth. So let me go ahead and click on post entry to QuickBooks. And what you're going to see, basically, it's a journal entry be posted into QuickBooks. Now, if I go to QuickBooks and I click on display journal entry list, I get basically a log of all the journal entries that I have posted through the fixed asset manager. So right here, this is the journal entry that I posted. It tells you the date, it tells you when it was done, what date, what time, it tells you what the journal entry is, and even if it has a journal entry number. But let's go into QuickBooks and see what that looks like. Okay, so see how the accumulated depreciation now, it's a bigger number, 4653.62. I'm going to go ahead and double click that, and I'm going to double click on the actual entry, and we see that the journal entry was entered automatically. Now, a really important piece, that one asset that I created, which is, and this is extremely important, this asset that I created, the Toyota truck, I haven't really entered the accounting event. That's really important. Even though I created a fixed asset, you still have to create the actual transaction. So if let's say, for example, I bought that truck and maybe I bought it with some financing, I have to actually enter the transaction itself. So when I actually paid, let's say, for example, a down payment, I have to do that in QuickBooks, and I have to use that particular item. So let me go ahead and go into the check here, and then I'll put here that I paid Toyota. So I'll create the vendor here called Toyota. And let's say, for example, that I paid Toyota, I think it was February 10th, 2016, and I paid Toyota, let's say $2,500, but the actual amount of the item that I purchased was $2,360. So when I actually click on items, not expenses, but items, and I hit my drop down, I can actually go into my fixed assets that are here. I can select my Toyota truck. that information about the purchase will come in automatically because I already kind of did my homework by putting it on the fixed asset list. And then because I only paid $2,500, then maybe I can book the difference to a loan, right? So I can put here auto loan or something like that, book the difference to loan. And this is kind of a tricky entry, so if you've never kind of seen this before, sorry about the trickiness behind it. But assume for a second you were buying the truck cash, and then you would just have the same 2360 up here, but I'm just kind of showing you how it will work with a down payment. Anyway, so you still have to book the accounting event. Putting it on the fixed asset list is not enough, so you still have to book that initial purchase there. The fixed asset list, what it will do is just help you or aid you through the actual pushing of that journal entry. Now, one of the real valuable pieces is the report you get within QuickBooks. Although we noticed that there were some really powerful reports in the fixed asset manager, QuickBooks itself also has some really nice reports. So let me go into reports. I'm going to go into list, and then I'm going to go down to fixed asset listing. There's my two assets, but what's really nice about this is I can click on customize report, and I can actually choose a couple of interesting things here. So I can pick, which is my asset account, and then I can go back. Actually, not the asset account. There's just the regular account that's already here. That's good. Let's see. Let's go down to some of the depreciation related information. There we go. Cost basis, accumulated depreciation, book value, some really interesting pieces here, sales date. So all these things here are relevant to the fixed asset list. So let me go ahead and click OK. And now we get a report that actually contains accumulated depreciation, cost basis, book value, all by asset. And this only happens when I do that update. Remember when I did QuickBooks, save assets to QuickBooks? When I do that button there, save assets to QuickBooks, that's when QuickBooks is ready to show me a fixed asset list with my depreciation, my book value, my cost, all that extra information. So I hope that you like the fixed asset list, and then you start using the fixed asset list to manage your fixed assets from now on. All right, perfect. So if you don't already subscribe to QB Power Hour to watch the webinars live, and you watch them, the recordings through YouTube or whatever, make sure you go to qbpowerhour.com to register and watch any of the upcoming sessions. We're going to have an upcoming session November 3rd. We're going to be talking about QuickBooks Payroll Advanced QuickBooks Payroll Tips and Tricks. On November 17th and December 1st, we're going to have ACE approved courses. So if you're an advanced QuickBooks Pro advisor, we're going to have 2 courses. The specific topics are to be determined, but we're going to have two courses that are ACE credit approved. Then on December 15th, we're going to do top apps of 2016. So we'll recognize some of our favorite apps, Michelle Long's and my favorite apps that we've used throughout the year. And then we're going to just keep going in every other week, we're going to have a session. So again, thank you very much for joining us. Go to Facebook and search for QB Power Hour. Join the Facebook group to continue the conversation, ask questions, interact with fellow QuickBooks fans. And until I'll see you in 2 weeks.